Okay, welcome to Seal and Fusion. We have a few more students in the class, but we'll go ahead and get started because it's 6:05. So this is just three of us. Okay, so let me know if you can hear if you can't hear me. There's also a chat feature in which if you want to post anything to the chat, you can post it to the chat and you can unmute yourself and speak that way. But I'm going to record this because there's some students that aren't here. That way, and as well as you students, you can access it later if you want. And then if you need to catch up on anything, it'll be recorded. We'll do that. So feel free to post to the chat or unmute yourself or anything like that if you have any questions. Um, okay. So if you haven't used WebEx before, it's pretty easy to use. It's a lot like Zoom, and I think you'll see a lot of the features are similar. I'm going to be sharing my screen. I'm going to walk you through the Blackboard page and the syllabus. Again, this uh, whole session will be recorded just in case we need to access it later. Okay, so why don't we start with just going on the Blackboard page, looking at the syllabus. So this is an independent study, which means that we're not going to meet in person. We don't have an assigned classroom, and it's going to be for econometrics and finance, Fin 570. We'll have a textbook and some major assignments, but no attendance grade and no requirements to actually meet because it is independent studies. So that means that I kind of do the work and you do it independently. But I'm here for questions. I do a few of these Zoom meetings and I hope they're helpful. And then I can also do some additional office hours if that's needed as well. So why don't we start? I kind of put main things at the top of the Blackboard page. So can both of you see? Both of you can see my screen, right? I'm sharing the screen. Okay, great. All right. So if you click on the little top part, I put a syllabus and assignments. And so what I did, because this is an independent study, I've taught this class a number of times, but this is the first time teaching it as a direct study. So I kind of modified it a bit because I think it'll be better this way. And so if you click on the syllabus, let's start with that. Okay, and welcome whoever just joined there. All right. Hello, welcome.
Thank you, sir.
Thank you. Okay, so right now I'm going to go through the syllabus. So you're welcome to. You probably want to keep your microphone off, but if you have a question, turn it back on. There's also a chat feature. So if you have a question, turn the microphone back on, or you can post it to the chat. I put something like welcome, and there's that option as well. Okay, so this is going to go for, we're already in week 2. I think this is the second week, but this goes for about 7, 8 weeks. And so I kind of structured it as such. So this is Econometrics and Finance, Fin 570, and it is welcome, Hazel. Okay, good to see you back.
Sorry, I'm late. Thank you. Yes.
No, it's okay. It's all right. Our first Zoom meeting. It's all, like I said before, it's all being recorded, so don't worry about missing anything, and you haven't missed anything yet. And okay, so this is econometrics and finance. And like I said before, I've taught this class a number of times, but this will be the first time teaching it as a direct study. It'll be kind of fun. So this is a textbook I normally use. It's Introductory Economics for Finance by Chris Brooks. And this is the textbook. We're not going to, I'm going to give you some reassignments. You won't be required to kind of read the whole textbook because I've kind of structured the class. There's kind of 3 big assignments, and I'll kind of walk you through that. Also, if you go to, I haven't got here yet, but if you go to syllabus, The textbook full version is here as a PDF. So you're welcome to refer to that as well, because I think this is the whole current version. Okay. Okay. Now, here's how the course will be graded. So you are going to have a couple kind of little research projects in the final, and that's really going to consist of your grade. So I'm going to do these meetings probably 3 or 4 throughout the semester or the term, whatever you want to call it. Attendance won't be checked or required, and that won't count against your grade. But I would recommend coming because these should be helpful and kind of what the goal here will be to kind of walk you through the projects and walk you through the final, and then might have another meeting for some other catch-up things. But we'll have at least 3 meetings because I want to spend at least one for both of the projects and then also the final. The structure is as such. So the first project's 35 points, the second project's 35 points, and then the final 30 points. So your full grade will be based on those kind of 3. Almost like a 30-year grade goes to each thing. Okay, and I kind of did it where there's nothing due for a couple of weeks, so I knew there's some students that are still registering for the course, and I think we still have maybe 1 or 2 students that have not got their paperwork processed, so maybe a few late adds. So I didn't want to have things due right away. We can also, if the Thursday nights don't work great, you can always adjust the days based on demand, but we'll kind of see how it goes. But as of now, I think Thursday at 6 p.m. is a pretty good time for me, but we can adjust that if need be. All right. So if you scroll down in the syllabus, there's some key topics I want to address, and I'll kind of spend the meetings to kind of address these main topics. Today, we're going to cover the CAPM model and the arbitrage pricing theory, and that'll give you the foundation for the first project, which is due September 15th. So nothing due right away, but just note that one of your major assignments is due in about 2 weeks, and so just accordingly for that. And the last 2 assignments are both due on October 15th. So just give yourself a little time that you have those 2 big project/final coming up towards the end of the semester. Okay. So that's the syllabus. I think it's pretty clear. If any questions on the syllabus, you can let me know by posting anything to the chat or by taking off unmuting yourself, and then I can hear you that way. Feel free. Chat. Okay, let's chat yes. Right. So I put at the very top where it says syllabus and assignments. At the syllabus we went through, and then the 3 major assignments. So you kind of see them right there. So they're also located in different spots on the Blackboard page with some extra resources. But I wanted you to be aware that major things you have to focus on are on the syllabus, both of the projects which are here, and then the final. So just double check that when these deadlines are coming that you're going to meet these. So you really can't miss any assignments because there's pretty much 3 big assignments. So just keep in mind that those things are here. We'll look at the first project today. That's kind of the goal, is to get you started on the first project. Right. And if you go to syllabus, you got the syllabus we looked at. Some COVID-19 resources in case that's applicable. Accessibility services link for the university in case you need any special accommodations. And the PDF of the version of the textbook I'm using. You're welcome to use that version as well if that's usable. We will use some software in this course. For the first week and for the first project, I'm going to do most of the work in Excel. So I assume most of you have Excel. If you don't, you can click on this little Office 365 link. You can get a full student version of Excel, or actually for Microsoft not called Office anymore. I think it's called Suite, but whatever the full Microsoft version is, the university subscribes to it, so you can get Word and PowerPoint and Excel. If you don't have that, you can do that there. Kind of just put in your cool email address, and it's pretty easy to get the full version of Excel if you don't have it. Okay, not for today, but for coming up, we're going to use a software called eViews, which is also free, and then a software called RStudio, also free for some more advanced analysis, and that'll come for like the second project. For today, just make sure if you want to follow along, we're going to be doing a lot of Excel work, and so that's what you're going to need for today. But if you want to get a head start on the software, you can try to download the eViews student version or RStudio. And so RStudio works through Windows or Mac, and you gotta have the R platform before you download the RStudio because it works through R. And so, like, if you wanted to do it for Windows, click on this, download R for Windows, and then you would go and download RStudio because it kind of works through the R platform. So you don't have to do that today, but just kind of foreshadowing that we're going to use that at some point. And I'll kind of show you that if there's any tech issues downloading that, I can try to help you, but not important for today, but coming forward, you get a chance, try to download and get kind of softwares up and running, which would be RStudio, this one, and the eViews, which is a little like regression and statistical package, which is kind of used for different things as well. Okay, so those will be the things we're using in this course. Lots of Excel, a bit of eViews, and then quite a bit of R in kind of the second half of the course, particularly for Project 2. Okay, I have a bunch of lectures. I'm not going to go right to the PowerPoints to start these classes or to start these meetings. I'll try to do, the goal for today is to introduce the key concepts and the assignment for Project 1, which I want to walk you through and kind of show you how to get the data, what to do. I might refer to some of the PowerPoint slides for like a key concept or something like that. But we're basically, because this is kind of a independent study, the project consists of some material from chapters 1, 2, 3, and 4. So I would encourage you, especially because you have the textbook PDF version, you can kind of read some of those chapters, and kind of catch up on some of the material. And I'll refer back to some of the key things that are needed for the project. But we'll leave the lectures there, and then I'll kind of go back to them when they're relevant for the assignments. Okay, there's some links, some videos, some tables, which we can come back to. And there's I broke the rest of the Blackboard page into kind of key topics. So today we'll cover the CAPM topic. Okay, we'll come back to that. We'll cover the arbitrage pricing theory topic. And later on for Project 2 in the final, we'll cover these other things, which are more forecasting, exponential smoothing, ARIMA, and ARMA and unit roots. A little bit of panel data, and then here's the stuff for the different projects. And then here's, I think, I posted your final already if you want to take a look at it, but I might change a few things based on where we get in the course, but if you want to look at what the final might look like, it's already posted. And if you want to, there's nothing here yet, but if you went to Grade Center, after the assignments are due, I'll put your grades here. So your full grade's really based on each of the projects and the final, and it's kind of a additive point system. So you can get up to 35 points for each of the projects, up to 30 points for the final, and then your final score is based out of 100 based on those three main projects. And I won't pull up the projects, the grades once there's grades in there because I'm not supposed to share the grades, but just you can kind of see where you can check your grades once they start getting recorded. And okay, so the goal for today is going to be to cover the CAPM material, the arbitrage pricing theory material, then go through the project one, and then you should have plenty of time to do that. The deadline, which I think is September 15th. Then if there are any tech issues or questions along the way, you should have plenty of time to ask me. But that should give you a good start, and then we'll probably do maybe another meeting in a couple weeks and get some new material. But I think this is what I want to cover for today. Is these two main topics, which are very applicable to the first project. Then a few things that are on the lecture slides and the textbook that are relevant. Okay. So, any questions thus far on any of the course syllabus or deliverables? Good. Okay, and again, feel free to post anything to the chat, or you're welcome to unmute your microphone and ask any questions at any time. Okay, and one more time, we are recording this, so you can, if you miss something or you have some technical issues, you can always access the meeting later and catch up there. Okay. Yeah. When we go to sorry, not that. Why don't we go to the CAPM section? And this is kind of the first thing I want to introduce, which is going to be kind of half of your first project. And so this is going to introduce the capital asset pricing model. And you're going to do your own capital asset pricing model with a topic you choose. You're also going to do your own PT or arbitrage pricing theory, which I'll introduce in the next section. Okay, and so the idea here is, let me see if I can pull this. If you go to lectures, this one, I think chapter 3, this is the introduction to the CAPM. Oops. Okay, so we're going to do some simple regression and then some multiple regression for the first project. And so the goals of the course, kind of select some key topics, then use some econometrics or statistical techniques to explore those concepts in finance. And that way you can kind of use those same models or whatever you call it for further analysis. And so what we're looking to do here is start with just showing that grabbing some data, can you estimate some relationship between one variable and the other? Is there, when one of the variable changes, the x variable, we usually call it, what happens to the y variable? And we're going to introduce that in a specific context for this CAPM. So we'll start by looking at just one x variable and one y variable to start the econometric situation in one of these FinX topics. And we're gonna focus on essentially how asset returns vary, their level of market risk, and we're gonna look at how stocks are more or less volatile compared to the market average. And the goal of this kind of it's a very well-known topic, the CAPM. Useful because it will tell you kind of the what you want to do with these stocks if you're risk averse or so on. If the stock is more volatile compared to the market average, that would tell you that there's a bigger chance that you could hit it big, but also equal chance that you could kind of lose a lot. And the stocks that are more constant and less volatile would be kind of a safer bet. But with a safer bet, you would also not get the chance of kind of getting a big swing. So it kind of tells you, depending on how you want to invest, the simple beta analysis or CAPM will tell you if you want something more risky, with the chance for upside, you can go for a higher beta. If you want something more safe, you can go for a lower beta, which are kind of compared to the market average. So essentially what we're going to do, so- okay, so this is this slide is kind of the basis for the first part of our first assignment. And so kind of suppose that we have the following data on some excess return on a fund, portfolio, or a stock, and the excess returns on a market index. And so what you're doing is you're going to calculate or look at the excess return of some stock and then compare that to the excess return on the market index, so the market average like the S&P. See if they kind of move together or one moves more volatile compared to the other. And the way we're going to calculate this is kind of get these indices historically, get some stock prices, and calculate the returns, like the change over time, then calculate the excess returns, which would be the return compared to the risk-free rate. So just there's the risk-free rate means essentially if you want to buy like government securities or government bonds, the idea is that there's really no risk to do that because the government, or at least the U.S. government, always pays their debts, and so you're probably going to get a really low rate of return on a U.S. bond, but it's kind of a guarantee. So the risk-free rate is the return in excess of, sorry, the excess return is the return in excess of the risk-free rate. So what you would get if you didn't just invest in safe, low return government bonds. Okay, so the idea is going to be to kind of see if whatever stock we look at moves with or moves less than or more than the market average. So like if the beta was 1, that would mean that the stock or the excess returns of the stock move with the market. If the beta is higher, like a greater than 1, that would mean it's more volatile, bigger chance of hitting it big, but also equal chance of being down low. And if the beta is less than 1, that means it's a safer and less volatile than the market. So kind of it's a simple concept, but it's somewhat useful and kind of a nice, always a nice introductory econometrics and finance. So what we're going to do is do a little CAPM analysis example using some data in Excel, and then we could also do this in eViews. We're not going to do that today because I like the Excel version better. But we will use eViews at a later date to do some stuff like doing some plots and do some hypothesis tests and testing for some things. But today, we'll focus on the Excel version. Okay? So what I want you to do now is kind of go through a little example. I'll walk you through a little example on the CAPM. Then I'll build the foundations of what you're going to do for your project and kind of repeat the analysis with some up-to-date data. Okay, so if you go to the CAPM section on Blackboard right here, and I have a little example for you that we can kind of go through to see the idea, and then that'll help you kind of get the tools to replicate the model and do it with your own data. Okay, so you click on this let's see, CAPM raw data only. Right? And you click on this CAPM Word document here. So what we have is we're going to look at or try to estimate some CAPM models, interpret the results. So for example, we don't have to do all these, just to kind of get the idea of how to do the analysis. So let's say we want to use the Ford stock. So the CAPM formula kind of looks like this. This is return of like the returns of Ford. This is the risk-free rate. So this together is the return in excess of the risk-free rate. So these are the excess returns of the Ford stock compared to the risk-free rate. And this is the excess returns of the market. And you want to see if there's a relationship. And this beta, which is essentially the, when the market moves, what does this stock do? That'll tell you about the volatility or not so of Ford. So we can estimate this simple relationship for any stock as long as we have the data, some kind of risk-free rate like government bonds, and market index. Okay? So for this type of analysis, you can I'll show you how to do the Excel data analysis, interpret the results, and then when you get an idea, you can do it for your own project. So here, you would first get data on whatever index, like this is the S&P, like the S&P market index, right? And then this is the stock price of Ford, the stock price of General Electric, the stock price of Microsoft, and the stock price of Oracle. So 4 separate stocks to use as examples. A bit outdated, but the idea is the same. This is from January 2002, April 2013. Okay, this year, it's the it says 3M, but this is the annualized return on a U.S. Treasury bond. So if this is what you earned for, can expect to earn for a whole year, like risk-free, then you want to convert that to the same. These are monthly. So if this is what you can expect to earn for the whole year, then you'd want to divide that by 12 to get kind of the expected monthly returns. Okay, so if you start with this data, and were to transform it into the variables you want, I got it here for you, CAPM with transform data. Okay, so if you can see that, you can see that what we're doing is getting the, let me introduce this concept first because we didn't do that yet. So a normal return would be just like the stock goes up or down, what's the percent change? An easier way to do it is to use what's called the continuously compounded return, looking at the log change. So the lectures real quick, and then I think in chapter 1, I want to show you something. There we go. Okay. So this slide, chapter 1 in your textbook, shows you 2 types of returns in financial modeling. You're probably more familiar with the simple returns where it's just the variable goes up, the change over the original times 100 is the return in percentages. But easier and kind of also used metric that we're going to use for our projects is called the continuously compound returns. That's just 100 times the natural log of the newer variable over the older. So instead of doing this version, you can do this. If you do both, compare them, you won't get the exact same number. It's kind of like this might give you like 1.2%, and this might give you like 1.3%. They're close enough where it doesn't. You can kind of use them both interchangeably. So it's not the same exact measure, but it's very close. And this one is very popular in doing financial modeling returns. So this is the one we're going to use. And to get the return for any data, we're going to just take the natural log of the ratio of the newer price compared to the older price. So in this context, I'll show you what I mean. So here's our S&P data. Right? And to get the return, I'm going to tell Excel just take the natural log of, like if we're looking at the change from January to February, take the natural log of February divided by January times 100. That's it. So that would give you some nice metric of the return, which would be something like negative 2%. The good thing about Excel is you can kind of set up the formula you want and apply it down the whole column. So this just gives us we do it for a project. I'll walk you through it with an example, but I'm just kind of showing you what we're about to do. Okay. And then this separate column is, first of all, let me show you over here. This is the 1-year Treasury bond returns. So this is the risk-free return for a year. And we're going to divide those by 12 because if it's expected to give us that return for the whole year, then we want 1/12 of that for like 1 month because all of our stock prices are in monthly data. So if that's what we expect to get risk-free over a year, then 1/12 of that is what we expect to get risk-free for 1 month. Okay? So all the monthly Treasury bond returns are just yearly divided by 12, so the yearly return per month. And then what we do is our continuously compound returns, the natural log of the new number divided by the old. Then you can see the risk-free rate, or sorry, the excess returns are return minus the risk-free rate. So if this is what we get without taking any risk, if we do that minus that, that's what we get in excess of the risk-free rate. So excess returns, the excess returns above the risk-free rate. Sometimes it's negative because we had a negative return, but that's how you do the little excess returns. Then we do the same for other stocks. The continuously compounded returns, excess returns compared to the risk-free rate. You can do it for General Electric, Microsoft, Oracle. The process is the same. You're going to get stock price over time. You're going to, first of all, you're going to get the risk-free return in monthly terms. You're going to get some stock prices. You're going to get the return of that in terms of the natural log version, continuously compounded return, and then see what the excess return is compared to the risk-free rate. Then you're going to estimate a model where you see if the excess return of a stock is comparable or changes with or above or below excess return of the market. Okay? So to do that, Okay, so what you can do is, um, you don't have to do it right now, but you have to do it for your project. So I'll just take an example of one of these. So let's say we wanted to do the analysis for Ford. It's the first one there. So what I recommend doing is kind of opening up a new tab and take the data you want, is like kind of just the values, and run a little analysis. So I'm going to take a column, all the dates, and copy and paste it in a different tab. Okay, I'm going to take the excess returns of the S&P 500, so that's ER S&P. So I'm going to take this whole column and put that in the other sheet. All right, and if you paste just the values, that'll just give you the numbers, so you won't have to worry about any like formulas on different sheets and stuff like that. So I'd recommend just sticking with the numbers. All right, and then let's say we want compare it to Ford. So let's take the excess returns for Ford, which are column G. Um, one second here. This is let me bring that up again because something crashed there. So back to that same the CAPM with transform data. So let me try that again. I'm just tab. I'm going to place the date and the excess returns of the S&P and the excess returns of Ford stock. So let me get back to where I was here. There we go. Sorry about that. So we have data we need for the first CAPM for Ford. So we're going to estimate if this has an effect on this and see how the we're gonna estimate the Ford beta. So do that. We'd want to click on the Data tab, and there's a data analysis feature we're going to use to run a regression analysis. If you're using Excel right now or later, and you don't see the data analysis option there, you probably just need to activate it. So if you click on, I'll show you for Windows, if you click on the File tab and Options and Add-ins, and right here where it says Manage Excel Add-ins, click on Go button. And where it says Add-ins, it should show you, if you have the option, which you should, Analysis Toolpack. If you check that, assuming it's unchecked, hit OK. That should populate under Data tab the data analysis option there. It's a little bit different on Mac. I think if you're using a Mac, you want to just yeah, so just if you're doing a Mac, Tools on the very top of the screen, not in Excel, but like Tools Mac and Excel add-ins, then that should take you to the box which shows the data analysis option. You can just check it there. Okay. So you don't have to do this right now, but is there anyone here that's trying to follow along with me and can't get data analysis option to work? Like if you want to proceed, you gotta have that data analysis option. So you can let me know later if you have issues, but if you want to do it now and kind of follow along and make sure you have the options, you got to activate the data analysis. So let me know if you have any issues doing that. So we're going to run CAPM for Ford using data analysis tools in Excel. So what you would do is click on data analysis feature, scroll down to regression, and hit OK. All right, and the Y input range, this button, would be the stock you're looking at. Actually, let me do one thing first. Was that since I want to see the variable names in the output, I'm going to delete these little. The reason why we have those there is because you can't get a return without two pieces of data. That means the first observation is always going to be thrown out because there's no return if you don't have two things. So you can just delete the first January column. All right, and then you have data from February 2002. April 2013. Okay, so back to the data analysis option. Data tab, data analysis, regression, okay. And then your Y range is going to be the whatever stock excess returns you're looking at. In this case, it's Ford. So I'd choose C1 to C136, so the whole C column. I would choose the X range, would be the market average or the market index, the ERSMP. So B1 to be 136. Okay. Then if you click on this option that says labels, that'll give you the variable names. And also make sure that the ranges are the same, like you get 1 to 136, 1 to 136. And then hit OK. Okay, so what that should do is, let's see if I can make this a little bigger. Okay, what that should do is give you a little summary output of your regression results, which is going to have your beta. And the beta would be found in the coefficient for the ERS&P. So if you look right here, that's our coefficient. That's our beta for Ford. Okay, so Ford is at least during this time period was quite a bit more volatile than the market average. In fact, like 2 times more. Okay, or yeah, basically. So if you got that result, let me show you how to interpret that and kind of set up the CAPM equation for whatever stock. Um, anyone trying to replicate this analysis and wasn't able to do it right now? Okay, so let me based on the little CAPM analysis document, let me show you how to interpret that, how to kind of like these are the things you would need for your project when you repeat the analysis. So run a simple linear regression that takes the form excess returns of Ford is equal to some intercept plus beta for Ford. And here's the excess returns of the market, and then this is some error term. So you could just include a screen cap of your regression results, and that can be done just by kind of you could select all the summary output, copy it, Control C, and just kind of oops, I don't want to do that. There we go. Okay. You could paste a screen cap of your regression results. It shows you the results of the CAPM and the beta for Ford. Okay. And then if you recall from statistics or kind of interpreting a simple linear regression, adjusted R squared will tell you how much of the dependent variable you explain. Our dependent variable, or what we're looking to explain, is the excess returns of Ford on a scale of 0 to 1. So you would kind of say, based on R squared of 0.35, see that there, 0.35? That would tell you that on a scale of 0 to 1 or 0 to 100%, that's how much you explain for Ford variable. So this is the Y variable. Okay, so essentially this So this model explained about 35% of Ford's excess returns, which is the Y variable. Okay, so welcome, whoever just joined the meeting here. So that's how you interpret that for adjusted R squared. Okay. Then you want to see if your beta or your coefficient for beta is actually significant. For this, you can just look at the t-stat associated with it, which in this case is 8 point. So t equals roughly 8.52. Okay. And what that tells you is how valid the beta coefficient is. Is the data, is the result you got validated with real data, or is it just like a chance? And what you're essentially doing is just, I'd like you to simply kind of compare the t-stat to 2 in absolute value and see if it's bigger than 2. I'll show you why in a second, but that'll tell you if, kind of a rule of thumb, if this is a valid significant result. Okay, so is that bigger than 2? It is, and the reason you're looking for it to be bigger than 2 is if you look at kind of a t-table comparison. Let's look at lectures and t-table. So what this tells you, you can find any t-table, but this is one I found just searching. So this is our confidence level on the bottom, and usually you're looking for like a 95% confidence in your findings, because that would tell you that there's only a 5% chance that your findings are not right. And these are kind of degrees of freedom, which are essentially the number of observations minus the number of variables you use. So because our data set used about, or used exactly 135 observations minus the title, that would tell you where to look on the chart. Okay, so on this t-table, you went to like, here's 135 would be like around this area. You're looking for 95% confidence. You can see that the cutoff is something like 1.982. So really, if you get enough observations, like over 100 or even over like 50, the cutoff for 95% significance is usually, see how it's like just pretty much about 2. So that's why I say that that's kind of a rule of thumb. As long as you have like, uh, 20 observations, it's pretty, 2's a pretty good cutoff. So if your t-stat at least 2, you can go ahead and say that the result is significant and the beta is significant and that your results are validated. You don't have to pull up this table. I just wanted to show you where I got that arbitrary 2 from. So, because the t-stat for the beta is bigger than 2, and I mean bigger than 2 in absolute value, so if it was like -10, it's also bigger than 2, because you're looking at the absolute value. We go ahead and say that this is bigger than 2. The beta knew I wanted to say. So the beta coefficient is statistically significant. Right? And then the big thing is you want to interpret what that beta means in terms of how volatile that stock is compared to the market average or the risk-free rate of the market average. And so the market average is 1 default. And so what you want to do is take the beta and subtract 1 from it. And that'll tell you how more or less volatile the stock is compared to the market average. So let's see. Coefficient is about 2.02, right? From 2.03 right there. Okay, and I'm going to subtract 1 from it, which would give me 1.03. Okay, so that would tell me that percent terms, essentially, Ford's stock was approximately 103% more volatile than froze again. So Ford stock was approximately 103% more volatile than the market average. I'm just putting this into percent terms. That's really means like double. So 103% seems a little misleading, but it was about, yeah, almost double. Or do this number and convert that to percentage. That'll tell you how more or less volatile the stock was compared to the market average. If it comes out to 5, then that's 50% more. If it comes out to something, let's say it was, for example, let's say that the beta was like 0.6. Subtract 1 from that, that would give you negative 0. Negative 0.4. So that would tell you if the beta was 0.6, the stock was 40% less volatile. So you're comparing that beta to 1, where if it's lower than it, it's that much less volatile, and if it's bigger than it, like Ford's, it's that much more volatile. Okay, so you can you're going to do this analysis for some actual data. I'll walk you through that, and you could also take a look at the other examples. You're really doing the same thing for like General Electric, Microsoft, or Oracle to see if kind of practice to see how you get the beta from the data and what that beta means, and then some of the other analysis of the regression results. But what you're looking for, what you're going to replicate for like the first project, is do the analysis and get the results, interpret the adjust R-square, figure out if the beta is significant, and then what does that beta mean in terms of more or less volatile compared to the market. So doing the analysis I can help you with. This interpretation of the results, any questions on what I did here and kind of what the implications are and what we're trying to do with the CAPM? Is it kind of clear? Um, let me show you the other concept that I want to introduce before the first project. So you have some time. And again, if this is if everything is if this is takes some time to process, don't worry about it. This is being recorded. I can always set up more office hours meetings, but I just wanted to get you started on your project so you don't get overwhelmed with one of the big projects, which is due in a couple weeks. So the next big uh, aspect of the project is kind of expanding on this, something that we call arbitrage pricing theory. All right. So if you were to go to the APT section, which is arbitrage pricing theory, this is like a expanded version. It's like a add-on to the CAPM, where you're looking at more variables that also might influence the stock. Let me show you what the idea is. If you open up APT document here, okay. So this is arbitrage pricing theory, and for this example, we're looking at Microsoft, but you'll do this similar example for some historic data on whatever stock you choose. So what we're trying to do is determine whether the monthly returns on Microsoft stock, by monthly returns we mean excess returns, can be explained by unexpected changes in a set of macroeconomic and financial variables. The easiest method to do this is just assume naive expectations. Um, because if you do that, you assume that if you don't have any more information, then the value in the next period should be equal to the current value. So like if a stock price is 100, your best assumption might be that next month it'll also be 100 because why would it change if you don't have more information? So this being the case, the entire change in the variable from one period to the next, the unexpected change because investors are assumed to expect no change. So we're running an estimate for unexpected changes. Since we don't expect any change, then any change is assumed to be unexpected. That's the idea here is that if we don't have any information for any changes, there is a change, then you've got to assume by this theory that it was unexpected. Okay, so here's an example of an arbitrage pricing theory model. We'll do something similar, but not so many variables. So we're trying to see here if the excess returns of Microsoft are a function of excess returns of the S&P, which are just the market, the risk-free rate of the market. This variable, which is a change in industrial production index. This D credit, which is the change in consumer credit ratings from one period to the next. This is the change in inflation. This is the change in the money supply. This is the change in spread from um, the best rating, a triple A and then a B double A. So like if triple A investors get like the lowest rates and the second lowest rates go to B double A, and what's the variance there? And then this term is the change in that spread. And our term is the change in the risk-free treasury bonds. So you don't have to know all these variables, but the point is that they're trying to get a bunch of macroeconomic variables and see if the changes in those variables affect the stock. So can you use like changes in the money supply, or changes in inflation, or changes in spread between credit scores, can you use that information to predict or coincide with the stock price? Maybe, maybe not, but that's the point of the model. So you can run a multiple linear regression, which means you're just going to add more variables that could affect the stock, and see what the results are. Okay? So we're basically just starting with the CAPM, which would be this part, and then adding a bunch of macro variables, and the macro variables we're adding are changes because we're trying to do a proxy for unexpected changes. So let me know if you have any questions on what we're doing, but let me show you an example. Okay, under arbitrage pricing theory, Blackboard, right here. You could go to where it says APT, and there's a document with like let me show you the raw data first, just the macro Excel file here. All right, so a lot going on, but you can gather data on the stock you want to look at, S&P index, different macro variables like consumer price index, industrial production index. These are different measures of the U.S. Treasury bond returns, so with different terms, 1 year, 6 month of Treasury bond returns. This is the money supply. This is the consumer credit rating, and this is the spread from AAA ratings to BAA ratings. So what do best credit investors get in excess of the second tier? All right, and then you want to transform this data if you want to use it for an analysis into methods in which you're looking at changes. Okay, so if you open up macro variables edited, okay, so there's a lot going on here, but it's you're trying to kind of get the variables that you want to estimate, isolate those. So here's again, we started with the Microsoft data, and we got the continuously compounded returns. Okay, so basically just the natural log of newer data divided by the older, so the change. We got the excess returns compared to the risk-free rate. Did the same for the S&P. Okay, this one is consumer price index, and you're probably aware that economically, the change in the consumer price index is inflation. So if consumer price index changes, that's inflation, right? The change in the price level, and then change in inflation from one period to the next. We assume that's unexpected, so that's our measure there, de-inflation, which is a proxy for unexpected changes in inflation. Okay, and you could do the same for change in production, unexpected changes. You can do the same in R term. So that's the change in, what was the term thing? Was so the term is the change or the variance from 3-month risk-free bonds to 10-year. So what additional interest do you get in a 10-year in excess of 3 month? Right? And the change in that is the unexpected change. All right, and this is the money supply. And the change in the money supply is the unexpected change. Here's the consumer credit rating. And then the change in the consumer credit rating is the unexpected change. Last thing is the spread or the difference between best creditors and like the second tier, and B spread, right, is the unexpected change in that. Okay, so for this example, you want to estimate a model where this is the Y variable, ER, S&P, and then these things, the inflation, B production, R term, B money, B credit, and D spread, those are potential X variables, where this is just, I'm sorry, ERM soft is the Y variable. This is the beta variable, and these are macro variables where let's estimate that if the unexpected changes, which is just the change, have an influence on this. Okay, so if you open up macro variables only, I just put the variables that we're interested in one little file so we can just work with those. So goal here is to see if all these things, so this is regular FM beta 1, does that and all these other macro terms, when they change, does that affect or help us predict the excess returns of Microsoft? So to do that, to estimate that, you would look at your data analysis tools again. So let's see, data, data analysis, regression, okay, and our Y range is going to be the PR MSOFT because that's the excess returns Microsoft, the stock of interest. Okay, so in this example, A1 to A25. Okay, in the Y range, sorry, the X range is all the other variables in a big group. So it would be B1. You can select all this together. So B1 to H325. Okay, so there's your regression with the labels checked. So your Y range is A1 to A325, and your X range is B1 to H325. And you can hit OK button. Okay, so this is the result. These are the results of the analysis that you're trying to look at for the arbitrage pricing theory. Okay, here's the coefficients. Like there's your beta. And what you want to do is look at the other t-stats as well, and see if any of those numbers or those t-stats are bigger than 2. And if so, that would tell you that there's a relationship between the variables and the excess returns of the stock. But if you look here, all these numbers, -1, -0.5, 1.3, 0.3, 0.7, 1.7. None of those are high enough to confirm a significant result. So it doesn't look like, at least for this example, it might change when you do your analysis. It doesn't look like any of these macro variables are good predictors of the excess returns of Microsoft stock. But we know that which makes sense, the market was, because Microsoft is part of the market. So the best indicator from this analysis of what's going to happen to Microsoft is just looking at the market average. Okay. Remember, you would interpret this result as 1.36, so it's a little over the 1, beta of 1, which would mean that the excess returns of Microsoft is about 36% more volatile than the market average. So that was a lot of analysis, but I just wanted to show you how to get a start on the CAPM and get a start on the arbitrage pricing theory. And then I can kind of show you how to collect some data and do it for a little project. Any questions on the basic idea of the CAPM or the basic idea of the arbitrage pricing theory? Okay, let's go back to Blackboard for a second. Let me just pull up how this relates to your first project. And you don't have to start working on it now, but I kind of just, we'll probably have to do another meeting to follow up on it. If you go to project 1, and here's project 1 assignment, right? Okay, so what I want you to do in the next couple of weeks is kind of replicate arbitrage pricing theory and a CAPM for some actual data. So each student is going to do a short research paper using the techniques learned in class, which in particular is CAPM and arbitrage pricing theories. So they're nice little models or estimation techniques when you're looking at financial models and learning econometrics. So the project or paper is going to be submitted via email by Friday, September 15th. So you got over a couple weeks. It could be 5 pages. You're welcome to use 1.5 space, 2.0 spacing. If you want to, write some more, you can go down to 1 spacing if you want. Make sure that you include a reference section if you're using citations and do the proper citations. So the bulk of the analysis is to do your own CAPM and discuss the results, and do your own arbitrage pricing theory and discuss the results. Okay, so for CAPM, you're going to choose two stocks, perform a CAPM analysis, and compare contrast your results. And then you can use the same two stocks to perform an arbitrage pricing theory analysis, and you can compare and contrast results from that. I'll do an example. I'll walk you through it. Might not get through it all today, but you can use my example, and I'll record these lectures for comparison. But when you're done with it, so it's just a little research paper based on actual data analysis, a little abstract of what you found or what you found in your research. If there's any literature, you can talk about that. You use data, which you're going to use some data from Yahoo Finance. You're going to use some data from the Federal Reserve. And then the analysis, what you find and what happened. So kind of include your screen caps of your results, what the implications were, what's the beta, did other variables affect the stock? If so, what did you find? And if you had more time, what else could you throw in for another variable? And then if you have some references, make sure you list those in the citation section. Okay, so don't worry about this stuff yet. The first step is to get some data, start doing the analysis, and then I'll walk you through which of the macro variables you can use for your arbitrage pricing theory. Okay? So why don't we spend the rest of the time here? I'm gonna start doing an example, and the example will continue probably next time. But I'm gonna use two stocks as an example. I'm gonna show you how to get the data. I'm gonna show you how to set it up, and then you can kind of obviously don't use the same two stocks I'm using, but kind of get an idea of what you'd like to research, and then you can go from there. So okay, so I have an example here that needs to be updated, but it's the one I used previously. So project one instructor example, so you're going to want to start making a big data file like this, and you can go from there when you're ready to start doing the project. All right, so I'm going to open up the project one instructor example. Okay. So what all the stuff is different columns and data sets you're going to use to do your CAPM in your arbitrage pricing theory example or analysis. So I'm going to be using Pfizer stock and Johnson & Johnson as an example. So just don't use these two stocks for your project. If you want, you can kind of I like to think of two things that are kind of in the same, industry. Like this is pharmaceuticals. You can do like two car companies or two banks if you want, but you don't really have to. What you want to do first is, let's see. I guess what you want to do first is kind of start getting the data on the stocks, and then you can kind of transform it in the way you want. So what I have here is S&P stock index, returns of the S&P, excess returns. This is for Pfizer. This is for Johnson & Johnson, and this is monthly returns on government bonds. So that's the risk-free rate. This is the CPI, this is inflation and the change in inflation. This is the money supply and the change in the money supply. And then I threw in, which I thought might be an indicator sometimes, is the home price index, then like housing inflation, and then the change in the home inflation. So your goal, and when you start doing this, is to pick a stock and see if the excess returns of that stock, in this case, I have the excess returns of Pfizer. You can get the beta for that by looking at that compared to the excess returns of the market average, which is the ERS&P. You can do the same for Johnson & Johnson or your other stock. Okay, and then when you do the two arbitrage pricing theories, you're going to throw in more macro variables, in particular the unexpected change in inflation, the unexpected change in the money supply, and then the unexpected change in home price inflation. Okay, and so I think those are enough to the arbitrage pricing theory. So there's a bunch more in the example, but if you use inflation, money supply, and home inflation, that's enough to see if there's some correlation with the other macro variables. So first thing I want to show you is how to get the stock data. It's all free. It's easy to access. So if you go to Project 1 on Blackboard section, there's a link for Yahoo Finance. And what you can do is, this is one of the few things that Yahoo's so good at, is sharing financial data and in particular stock data. So what I'd like you to do when you get an idea of what you want to research, doesn't have to be now, but you can look for the stock name, or you can look for, if you know the symbol. Like I'm going to look just for Johnson & Johnson. Or do Pfizer first because it was my first one. So if I just look for Pfizer, it's likely that the first hit will be the one you want. So that's it. The symbol PFE is for Pfizer. Okay, so when you find the stock you want to look at and you go to this little home page, if you scroll down to historical data, this is where you're going to find the data and put it into Excel and do the analysis. So you can adjust the time period. And because I know that one of the variables doesn't have anything past 2001. So because of that, if you want to use the variable, you can't do anything before 2001, which is fine. So you want to start your date range at July 2001. That's what I'm going to do, because that's kind of where at least one of these variables starts, and you don't have to go, if you want to go back farther, you can try to find more data, but I'd recommend just starting at 2001 July. Right, so you can tell your time period. You go from you know what? I think the easiest thing to do is just choose the time period thing, hit the max button, and pick what you want later. So I'm just going to pick everything. The time period, max. You want historical prices. You want your frequency to be monthly. Okay, so historical data, time periods max, historical prices, and then monthly. You hit the apply button in Yahoo Finance. That's going to give you that data. Then hopefully if you hit this download button, that should download the data into a little CSV file, which you can copy and paste into your main analysis file. Okay, so you should see something like this, where you have data, you have monthly data for the stock, and they have the opening, high, low, closing, adjusted close volume for the stock or the stock price. And what you want this analysis is just the closing price, because that's the one you're going to compare the market average and get the beta, etc. So what you can do is when you're setting up your Excel spreadsheet, you can just kind of paste it, put your data here. So I know that, delete this for now. Oops, that was the wrong one to delete. Okay, so this one is Pfizer, and so I'm going to go ahead and just paste the updated data here in this section for the Pfizer price. So I'm going to paste Pfizer's closing price of the stock, 7/1/2001, and so you can use up to the current data point. So it might be that some of the other variables don't have it. It might be that some of the data is not on the same update schedule. There might be some data that's like up to September and some data that's up to July. And so if that's the case, you'll have to just kind of use the same time range. But for now, I'm just going to get all of Pfizer's closing stock price from 7/1/2001 to the current date. So so here's the closing price column. So there we go, 7/1/2001, all the way to 8/1/2023. So most likely you'll have stock data up to August 2023. If you want, you can, or you do it, you can cut and paste the closing price in that range. So most likely you'll have closing price, whatever stock you choose, from 7/1/2001 to 8/1/2023. So I'm going to copy and paste that and put it in my big data file. Okay, and I also need to update the date range because some new observation. So looks like I have a date range up to August 2022, but the data goes to August 2023. So if you kind of try to populate in Excel, I'll just do it kind of like this. There we go. Okay, so very first thing you're gonna want to do is kind of highlight the sections I did. Get a stock you choose, the closing price from 7/1/2001, and closing price for each of those dates. So it's monthly data, most likely from July 2001, August 2023. So about 23 years or so of data. Okay? And depending on the stock you choose, it's possible that you choose something that's newer, like didn't go public until like 2010 or something. Uh, if that's the case, you're welcome to use it. I'll give you a smaller data set, so less numbers, but just make sure that you have data up to the current observation, which is August. Obviously, if your data doesn't go back to 2001, you can't use it that far. So just use whatever you can get after 2001 up to the current observation. Okay, so first thing I did here is just get Pfizer's closing price. That's one of the stocks I chose. Historical times for July 2001 to August 2023. So everybody good so far? Let me know if you have any questions, and I'll keep doing some more of the analysis. We'll probably pick it up next time, but just, if you're trying to follow along or you go home and pick a stock and want to try to replicate this, you can let me know if you encounter any problems. But what we're trying to do is set up the big data file and then run the analysis and get some CAPMs for some different stocks, and also some arbitrage pricing theory models, and interpret the results. Okay, so why don't I go ahead and get other stock I'm interested in. In my case, I'm looking at Pfizer and Johnson & Johnson. So let me get Johnson & Johnson stock from Yahoo Finance. Okay, so if I go back to Yahoo Finance and I search for J, which is the Johnson & Johnson symbol, do the same thing. Okay, click on it. Then go to historical data. And I'm just going to choose I'm going to choose all the time periods and then just select what I want. The max time period, historical prices, and monthly data. Apply. Okay. And you can download that. All right. And so this is for Johnson & Johnson. So again, I got to have the same date range. So make sure that if some of your stocks have different date ranges, that you choose only what's common. All right. So I'm going to choose the closing price for Johnson & Johnson from July 2001 to the current date. So same range as Pfizer. So I'm going to paste that here in my Johnson & Johnson area. Okay, so there I got now. Also Johnson & Johnson stock up to August 2023. Now, another thing you need for, well, for the CAPM and for the arbitrage pricing theory is to get the market average or the S&P index. Okay, so if you go back to Yahoo Finance, and everyone's going to have different stocks, but everyone needs to compare it to the S&P index. So if you just search for S&P, you want this, the S&P 500 index. Okay, and you're going to put down a historical data. Same deal, all max time period, historical prices, and monthly data. And apply. Oh, I remember that you can't, I think this one doesn't have the download option, so I'd have to cut and paste it here. We want these closing prices, but not giving me a download option. So let me just open up a separate tab in the big spreadsheet thing. Then I'll cut and paste it in there, and then I'll get what I want. But this one's a little more tedious because it doesn't give you the download option. Okay. All right, I'm going to select everything from there we go, everything from July 2001 to current. That'll be the same date range. Okay, and then I'm going to paste it in this empty spreadsheet. Okay, so it should be pretty easy to do. And then I want to know what these are, but this. Okay, so it took a little copying and pasting, a little more tedious than just download, but we've got date, open, high, low, closing for the S&P, and we first the get sorted is in reverse order. So I'm going to resort it from oldest to newest, and then just copy and paste it in the data file. Okay, so if I select this and do data sort, and I sort by date from oldest to newest instead of newest to oldest. Okay. This should be all the data that we need for the S&P. I'm starting with July. Okay, so I'll put that in my S&P area. So at this point, I have data from July 2001, current for the S&P index, Pfizer's stock price, and Johnson & Johnson's stock price, and that's the basis for the CAPM. And then let me show you how to get the data for the CAPM. So you would want to get, I put the symbol here, this GS1M is the indicator for 1 month treasury bond risk-free rate, which when you compare your returns to the risk-free rate, that would be the excess returns. So if you go back to Blackboard, it says Project 1, and this other link, the Federal Reserve economic data, take you to this economic data set by the St. Louis Fed. And this has a lot of free variables like inflation and money supply. If you search specifically for GS1M, okay, it should give you what you want, which is the market yield on U.S. Treasuries at a 1 month constant maturity. All right, so that's essentially the risk-free rate of a Treasury bond if you just buy a 1 month bond. Okay. So just looking at it before we do the analysis, you can see that after the COVID situation, interest rates were super low, and which also means that returns on investments were super low. Now they're quite a bit higher because it coincides with higher interest rates. So you can kind of see what's goes on. Here's a little drop during recessions that kind of stay low, and pretty high now, but you kind of see what's going on. Regardless, you want to compare how the stock is doing compared to this free rate. Okay, so if you go to that little page, click on the max button. See, this is why I chose the range July 2001 to now, because this doesn't go back any farther. Okay. But if you hit download button and do Excel, okay. So let's copy and paste this data into our data file for the updated dates. So column GS1M. Okay, let me paste some updated data. So 7/1/2001 to 7/1/2001 to, it only goes to July, but that's okay. Let's take all that. All right, so right away we have 4 variables. starting in July 2001. But you can see that there's no observations for this one for um, August. So we're not going to be able to do anything for August because we don't have enough observations. So this whole area probably won't be used because if we don't have a variable for each thing, we can't go up to that date. We have to wait. We have to wait until we get the Treasury bond return for August, which we don't have yet. So cut our sample down 1 month. Um, next part is just getting, so I can get you through the whole CAPM part, and then we'll get to the other stuff later. To calculate returns, nothing would be in your first column. So our S&P is the returns of the S&P index. So nothing would be in your first column because you have it, you got to have at least 2 observations to get a return. So if you go to like the second one and just type in equals natural log of August divided by July times 100, that would give you the continuously compounded returns. Okay. And if you apply that formula down, it would give you the continuously compounded returns for all the market average. Okay, and then to get the X, so we got this column. Okay, to get the excess returns, all you're doing is starting in the second observation because there's nothing in the first one. You're just going to take the risk-free return and subtract the GS1M, which is the risk-free rate. So it's the return of the risk-free rate. So for this one, it would be C3 minus K3, which is the return of the S&P minus the risk-free rate. You could apply that formula to get all the risk-free rates. Okay, so we're approaching 8 o'clock, so I don't want to go too long because it looks like we've already lost some participants. We're approaching the 2-hour mark. So we'll stop here. But we'll do another meeting in the next coming weeks or so, or probably next week. And I'll kind of take you to the next step on the project. In the meantime, you can look through the first couple chapters until you get to the CAPM theory and the arbitrage pricing theory. Look through those examples and what we're doing. And what you want to start doing at some point is pick a couple stocks that you want to research and start setting up your data set and calculating your excess returns. I'll show you how to get these other macro variables next time or later time. In the meantime, I'm just going to start looking through the first couple chapters, focusing specifically on the CAPM and the arbitrage pricing theory, and start looking at what you want to research for your project. And if you start getting data and have any issues or need some help with the material, you can let me know. But we'll start with that. Hope that was somewhat helpful and get you a little bit started on your project, which isn't due for a couple weeks. I wanted to get at least started on that, so you have an idea of what you're doing, and you can get started on that at your convenience. But anything else? Any questions before we wrap it up? I'll save this thing I did and post it so you can look at it for reference. Anything else before we close up here? Okay, well, we'll stop there. I'll reach out for another meeting and let me know if you get started on your project and have any issues or any with the material. But hope that was somewhat helpful and thanks for joining. And I'll see you. We'll be in contact and have a good rest of your weekend.
Thank you.
Oh, thank you.